If you bought 100 shares of General Motors back in the summer of 2023, and you put them in a drawer and just completely checked out the stock market for the last 3 years, you'd wake up today to a really bizarre reality.
You'd probably be pretty confused, yeah.
Right, because you didn't buy a single new share, you didn't reinvest any dividends, and yet somehow your 100 shares now represent a 35% larger ownership stake in the company.
Which is just, I mean, it's a massive shift.
It's crazy. You own 35% more of the factories, 35% more of the intellectual property, and 35% more of the future profits. And the company didn't issue you a bonus or anything.
No, not at all.
Instead, GM used this staggering mountain of cash they generated, mostly from selling pickup trucks, to basically ruthlessly buy out your partners and wipe their shares out of existence.
Right. And it fundamentally changes the math of holding the equity for you.
Yeah.
I mean, we are looking at one of the most aggressive, sustained capital reallocation strategies in, well, modern industrial history.
Mm-hmm.
And they're executing this in the middle of a deeply chaotic macroeconomic environment, which is the wild part.
Exactly. And that dynamic is exactly what we are tearing into today. Welcome to a special Talk Tickers edition of this deep dive. Our mission today is to cut straight through, the Wall Street analyst speak and the corporate PR gloss of General Motors Q2 2026 earnings call.
Because there's always a lot of noise on those calls.
It's so much noise. We have a mountain of data from the first half of the year, and we are going to extract the actual signal here.
Let's do it.
The core question we need to answer for you, the retail investor, is this. Are these numbers just a temporary sugar high engineered by share buybacks, or is GM actually building an impenetrable fortress out of its legacy business?
We really need to look closely at the underlying quality of the operating income here. I mean, the buybacks are the headline, sure.
Right, they get all the attention.
Exactly. But the mechanics of how they are funding those buybacks, that reveals the actual health of the underlying business. We have to skip the pleasantries and jump right into the top line data.
Okay, let's get right into those headline numbers then. First half of 2026, GM posts $92 billion in revenue.
That's a huge number.
Huge. And Q2 alone was $48 billion, which is a $900 million jump year over year. But the metric that absolutely jumps off the page for me is the earnings per share.
Oh, yeah. The EPS is wild.
On a diluted, adjusted basis, their first half EPS came in at $7.27 a share. That is a 35% increase year over year.
Which, just for context, management pointed out on the call that this 6-month period beat 6 of their last 10 full years of EPS.
Wait, really? 6 months beat entire previous years?
Yeah, full years. Just in the first half of 2026.
Okay, see, my immediate reaction to a 35% jump in a legacy auto business is, well, it's skepticism.
Sure.
When I see EPS skyrocketing that fast, I just assume the denominator, the share count is doing all the heavy lifting, financial engineering.
And your skepticism is totally warranted. I mean, this shrinking denominator is undeniably a massive catalyst here.
Yeah.
When you retire 36 million shares in a single quarter.
Which they did in Q2.
Which they did in Q2, exactly. The profit allocated to the remaining shares mathematically has to spike.
Right. Right, it's just division.
Exactly. However, focusing solely on the buyback obscures the fact that the numerator, the actual cash profit, is also expanding.
Okay, so they're actually making more money too.
Yes. If we look at EBIT adjusted, which is their core operating profit before interest and taxes, it hit $3.9 billion for the second quarter.
Wow.
Yeah, that is up $900 million year over year. So we aren't just looking at financial engineering. We are looking at financial engineering fueled by really highly resilient operational growth.
Okay, the metric that proves that operational resilience for me is the North American margin. It came in at 8.6% for Q2.
A very strong number.
Because for years, GM management has defended this target window, right? Like an 8% to 10% operating margin in North America.
Yeah, that's their gold standard.
Right, and they slipped out of it recently when, the inflation spikes happened and those brutal rounds of tariffs hit.
It was a tough couple of quarters.
So the fact that they have clawed back 2.5 points of margin in just 12 months is serious, because finding 2.5 points in heavy manufacturing, that usually requires either firing a massive amount of people or, finding a way to make the customer pay significantly more for the product.
Well, it's largely the latter here, combined with a real stabilization in their logistics network. Auto manufacturing, you got to remember, is a game of fixed cost absorption.
Right. The factories cost the same whether you build one car or 1,000.
Exactly. When you are running plants at maximum capacity, every incremental vehicle rolling off the line carries a much lower burden of overhead.
Makes sense.
So that 8.6% margin tells us that GM has successfully passed the bulk of their commodity inflation and the tariff costs right on to the consumer. And the consumer just hasn't blinked.
They just keep buying.
They do. They maintain absolute pricing power in their core segments, which allows them to protect that 8 to 10% window even when macro conditions are hostile.
Which brings us to the core engine of this entire machine. If you read through the Q2 call transcript, it becomes abundantly clear that GM's entire financial universe right now revolves around a single dominant asset.
The ICE business.
Yes, the internal combustion engine vehicle business in North America. Specifically, full-size trucks and SUVs.
The cash cow.
Exactly. The market share numbers here are almost anomalous. Through the first half of 2026, GM held a 42% share of the U.S. full-size pickup market.
And just to contextualize, a 42% market share in an oligopoly like the Detroit 3,
Right.
They're running more than 10 full percentage points ahead of their closest rival.
That is massive.
It is. They're effectively capturing nearly half of the most profitable automotive segment on the planet. And they're doing this despite dealing with, lower than target dealer inventories for most of the year.
Wait, so they didn't even have enough trucks on the lots?
Right. Demand is vastly outstripping their capacity to physically build and ship these trucks.
And it is not just a volume play either. It's a mix play. We've seen this shift where, a pickup truck is no longer just a work tool with crank windows and vinyl seats.
Oh, not at all. They are luxury vehicles now.
They really are. The profit per unit on their full-size pickups and SUVs has increased by more than 25% since 2020.
The trim strategy is where that margin expansion really happens.
Yeah.
They have leaned heavily into premium sub-brands. You've got Denali, Denali Ultimate, and the AT4 trims for GMC.
Right. The ones that cost like 80 grand.
Exactly. When a consumer opts for an AT4 or a High Country, they are essentially paying a massive premium for higher margin components. We're talking upgraded interiors, specialized suspensions, advanced software packages.
But underneath, it's the same truck.
Essentially, yes. The fundamental architecture of the truck, the frame, the powertrain, the stamping it, remains largely identical to the base models.
Oh, wow.
So that delta between the fixed platform cost and the premium trim price, that just goes straight to the bottom line.
It's basically the Porsche business model, but applied to a heavy-duty pickup truck.
That's a great way to put it.
But the ICE dominance isn't just restricted to the giant trucks. The data shows their crossover portfolio, so vehicles like the Chevy Trax and Equinox, is seeing a 4x increase in unit profitability since 2020.
Which is a huge turnaround.
Right, because how do you quadruple profitability on a compact crossover?
Yeah.
Historically, that's a hyper-competitive, super low-margin segment.
You do it through aggressive platform consolidation, and you reduce the build complexity.
What does that mean in plain English?
Well, historically, automakers would offer a dizzying array of build combinations for a crossover. You'd have different engines, endless interior options, varying tech packages.
So the dealer would have like 50 different versions on the lot.
Exactly. And it created a nightmare in the supply chain and on the assembly line. It's so expensive to manage that.
Yeah.
What GM has done over the last few product cycles is radically simplify the order banks.
Oh, so you just get fewer choices.
Right. They build fewer highly targeted configurations. This reduces manufacturing complexity, lowers supplier costs, and honestly, it limits the need for heavy discounting because dealers aren't stuck with undesirable, weirdly optioned vehicles that nobody wants.
Speaking of discounting, that's usually the telltale sign of weakness in the auto sector, right? The cash on the hood.
Always.
Because when inventory piles up, manufacturers start throwing $5,000 rebates at consumers just to keep the factories running. But GM's U.S. incentive spending, the discounts as a percentage of the MSRP has remained 1.5 to 2 points below the industry average for over 3 years now.
And maintaining that discipline is incredibly difficult right now, especially when interest rates are pressuring consumer monthly payments so much.
Yeah, 8% auto loans hurt.
They really do. So the fact that their incentives are well below the industry average, it indicates that the product itself is driving the transaction.
Not just a subsidized financing rate.
Exactly. It proves the consumer perceives intrinsic value in the current vehicle lineup. They want the car, not just the deal.
I also want to touch on the fleet sales data because the earnings call highlighted the best first half for fleet sales in over 5 years. They specifically pointed out record full-size pickup deliveries and the highest level of government vehicle sales since 2009.
Which is a very interesting detail.
Right, because historically, as a retail investor, you view fleet sales with a lot of suspicion. It used to be a dumping ground.
Absolutely.
Like, if a car company couldn't sell sedans to regular people, they'd just offload them to rental car companies at a massive discount, which destroyed the residual value of the car just so they could recognize the revenue for the quarter.
That historical context is totally valid, but the mechanics of modern fleet sales, particularly for GM right now, operate very differently.
How so?
Management was explicit on the call that they are now ruthlessly strategic about allocation. The growth we are seeing here isn't dumping compact cars into rental fleets.
What are they selling?
It is high-margin commercial vehicles, heavy-duty trucks, specialized vans. These are going to construction firms, logistics companies, and government contracts.
Oh, okay. So actual work vehicles.
Exactly. These are B2B transactions that carry strong margins, and they often include lucrative long-term service and parts agreements.
Nice.
They are actively choosing to allocate semiconductor chips and manufacturing time to these fleet orders because the math actually makes sense now.
Okay, so the ICE business is basically a fortress. It generated $6.3 billion in adjusted automotive free cash flow in the first half of 2026.
A massive number.
And just to clarify for the listener, this is the cash remaining after every bill is paid, every factory is maintained, and every R&D project is funded.
Right, pure free cash.
And they took $2.8 billion of that cash and fired up the buyback machine. In Q2 alone, they bought $2 billion of their own stock on the open market.
This is where we circle back to that 35% reduction in the share count since Q2 of 2023.
Yep, the drawer analogy.
Exactly. By continuously sweeping the open market for their own shares, they are providing a persistent bid under the stock price. Mm-hmm. And simultaneously, they're concentrating the earnings power for the remaining shareholders. And with nearly $20 billion in automotive cash still sitting on the balance sheet, plus another $3.5 billion remaining under their current share repurchase authorization, there is every indication this aggressively shareholder-friendly capital return policy will persist.
But, and this is a huge but, this cash cow is carrying an incredibly heavy burden right now.
Very heavy.
Because it isn't just funding stock buybacks, it is single-handedly bankrolling the electric vehicle pivot. And the sources revealed just how excruciatingly expensive and messy that EV pivot has actually become.
It really has.
It's not a seamless transition at all. It's a brutal restructuring. In Q2 alone, GM took a $2.2 billion incremental restructuring charge strictly related to their EV operations.
Yeah, and the term restructuring charge can sometimes sound, kind of abstract on an earnings call.
Yeah, like accountant speak.
Right. But if we break down the mechanics of that $2.2 billion, it reveals the sheer physical and financial friction of changing a century-old industrial base.
Break it down for us. Where did that $2.2 billion actually go?
Well, $900 million of that charge went to direct cash payouts to suppliers.
Just paying them off.
Another $700 million were cash charges to renegotiate and right-size their battery supply chain with their joint venture partners. And the remaining $700 million were non-cash write-offs for compliance-related asset impairments.
So essentially, this looks exactly like a corporate divorce settlement.
That is exactly what it is.
Because GM made massive multi-billion-dollar commitments to suppliers and battery partners years ago, right? And that was based on incredibly optimistic EV adoption forecasts.
Forecasts that just didn't pan out.
Right. Now that reality has set in and consumer demand for EVs has just flatlined compared to those early projections, GM is having to pay massive penalties just to break those contracts, scale down production targets, and essentially right-size the whole operation.
It is the literal financial cost of recalibrating expectations to reality.
Yeah.
I mean, the original agreements likely featured take-or-pay clauses.
Meaning what?
Meaning GM was legally obligated to purchase a certain volume of battery cells or raw materials, regardless of whether they could actually sell the cars.
Wow, so they were on the hook either way.
Exactly. Buying their way out of those volume commitments is painful in the short term, clearly, but it prevents them from building highly unprofitable inventory in the long term.
And this Q2 charge is just the latest installment. The transcript notes that since the second half of 2025, GM has recorded a staggering $10.9 billion in total EV-related restructuring charges.
It's hard to even wrap your head around that number.
It really is. That is $10.9 billion of capital incinerated just to fix past strategic forecasting errors.
It is a massive number. However, for a retail investor modeling the company's future cash flows, it is critical to separate the accounting reality from the cash reality here.
Walk us through that. What's the difference?
Well, of that $10.9 billion total, about $7.2 billion consists of non-cash write-offs.
Okay, so money didn't actually leave the building.
Yes, exactly. This represents the accountants devaluing physical assets. So maybe retooling equipment for an EV architecture that is no longer viable, or writing down the value of obsolete battery chemistry.
Got it.
It damages the GAAP earnings on paper, but it doesn't drain their actual cash reserves. The actual cash burn to settle these issues sits at roughly $4.5 billion through the end of Q2.
Okay, $4.5 billion is still a tough pill to swallow, but it's a lot better than $11 billion.
Right.
But management is pitching this as the final bloodletting, right? Like they're taking the hit now to stop the bleeding on the income statement later.
Precisely. By absorbing these restructuring costs now and right-sizing their manufacturing footprint, they expect the operating leverage of the EV business to improve dramatically going forward.
Did they give numbers on that improvement?
They did. Management provided guidance that their overall EV losses will improve by $1 billion to $1.5 billion this year, specifically due to these actions.
Oh, wow.
And we are already seeing the impact. $500 million of that benefit was realized in the first half of the year. So the heavy lifting of the restructuring is largely behind them.
Okay, so they are finally clearing the wreckage of the EV pivot, but they are immediately walking into another massive macroeconomic buzzsaw.
The tariffs.
Yes, global trade tariffs. And the numbers here are eye-watering. GM is projecting gross tariff costs of $2.5 billion to $3.5 billion for the full year.
It's a huge tax on the business.
In the first half alone, they already ate $1.3 billion in net tariff costs, and they are modeling a $900 million hit in Q3 and another $900 million hit in Q4.
Taking a $900 million charge every 90 days strictly due to geopolitical friction, I mean, that is a severe headwind.
Yeah, that's out of their control.
Right. It impacts the cost of raw materials, electronics, cross-border component shipments. The fact that they achieved that 8.6% North American margin while absorbing these costs is honestly a testament to the sheer profitability of the underlying vehicle sales.
But they aren't just going to accept a $3 billion annual tax on their supply chain forever, are they?
No, they're not just sitting on their hands.
Right, because they are executing a defensive maneuver. The transcript details $1 billion to $1.5 billion in investments this year dedicated to onshoring.
Yes.
They are basically physically uprooting manufacturing capacity and supply lines from overseas and moving them into the United States to get inside the tariff walls.
And onshoring is highly capital intensive upfront. You have to acquire real estate, build facilities, retool assembly lines, and train a totally new domestic workforce.
It sounds expensive.
Very. For instance, they spent $400 million in the first half of the year just preparing to shift production of the Cadillac Escalade to the Orion assembly plant in Michigan.
Wow. Just preparing.
Just preparing. Those costs will ramp up heavily in the second half of the year as they prepare for full production in 2027. So it is a massive capital expenditure, but it is a necessary permanent structural fix to insulate their margins from unpredictable global trade policies.
Okay, so this paints a very clear picture of GM's current capital allocation triangle, right?
Right.
They generate mountains of cash from selling internal combustion trucks. That cash is split three ways. One, rewarding shareholders by aggressively buying back stock.
Yep.
Two, paying the $10.9 billion divorce settlement to fix the EV supply chain.
Check.
And three, spending billions to onshore factories and hide from tariffs.
That sums it up.
If that were the whole story, it would be a solid, if maybe traditional, industrial play. But there is a fourth dynamic buried in this data that completely changes the valuation multiple of this company.
And this is the exciting part.
It really is. The high margin recurring revenue engine.
A digital and services portfolio. This is the pivot from transactional revenue, selling a piece of hardware once to recurring revenue, monetizing the software inside that hardware every single month.
The holy grail for any hardware company.
Exactly. In Q2, GM's recognized revenue for OnStar and their digital business hit $800 million.
$800 million in a single quarter.
Yes. That is a 20% growth rate year over year. They are currently on a run rate to exceed $3 billion in recognized software revenue this year.
Okay, pause for a second. $3 billion in software revenue is not an automotive number.
No, it's not.
That is a mid-sized Silicon Valley tech company hiding inside a Detroit automaker. And the core driver of this growth is Super Cruise, their advanced driver assistance system, right?
Yep, the hands-free driving tech.
They just logged their best quarter ever for vehicles equipped with the technology. But the real catalyst is what happens next year.
2027 is going to be huge for this.
Because in 2027, they are making Super Cruise standard hardware on all high-end trims of the Silverado and Sierra pickups and optional on almost the entire remaining portfolio.
They estimate this hardware rollout will put an incremental 160,000 Super Cruise-equipped units on the road next year.
That's a lot of potential subscribers.
And the strategy is straightforward. You embed the hardware into the vehicle cost from the factory, you offer the buyer a free trial period, and then you convert the driver into a paying subscriber once they experience the utility of hands-free driving on the highway.
Which is brilliant. And the analysts on the call zeroed right in on this. Because if you make a $5,000 piece of technology standard, you either have to raise the price of the truck by $5,000, or you have to be absolutely certain you will make that money back on the subscription tail.
Right, you can't just eat that cost.
Right. Joe Spack from UBS actually pushed management on this, asking if making it standard would give them a pricing tailwind. And the response was fascinating. Management revealed they are seeing attach rates of 30 to 40%.
Which is incredible. An attach rate of 30 to 40% for a premium automotive subscription is an incredibly strong signal of product market fit.
It means people actually want it.
It means that nearly 4 out of 10 consumers who try the hands-free system decide that the reduced driving fatigue is worth a persistent monthly fee.
Yeah, once you don't have to steer on a road trip, you don't want to go back.
Exactly. And the economics of this revenue stream are completely disconnected from the physics of bending metal.
What are the margins on it?
Management has previously disclosed that OnStar and digital services carry margins in the neighborhood of 70%.
A 70% profit margin.
Let that sink in.
In a business that traditionally celebrates hitting a 10% margin, an $800 million quarterly revenue stream running at 70% profitability is transformative.
It changes the whole P&L.
And this software push has driven their total deferred revenue, which is cash they have collected for subscriptions that they will recognize over time, to $6.3 billion.
Yep.
That is up almost 50% from a year ago. They are tracking toward 1 million new subscriptions this year across their entire digital ecosystem.
And what's interesting is this recurring revenue strategy isn't limited to software in the dashboard either.
No.
The transcript highlighted significant momentum in GM Defense and GM Insurance as well.
Oh yeah, GM Defense. I saw that.
GM Defense is scaling quickly. They're leveraging existing commercial platforms for military applications. They are targeting yearly $700 million in revenue for 2026 and expect the division to turn EBIT positive this year.
I actually looked into this, and they aren't trying to compete with Lockheed Martin to build fighter jets or anything.
No.
They are doing what they do best. Modifying trucks. They took the Chevrolet Colorado platform, altered the suspension, stripped it down, and created the infantry squad vehicle, the ISV.
Right, for the Army.
Right. The U.S. Army initially ordered 1,200 of them, but they just expanded the procurement plan to over 10,000 units.
That's a massive scale up.
Yeah, that single contract modification pushes the ISV program well past $1 billion in expected revenue.
It is a brilliant arbitrage of their existing R&D. Think about it. They take a platform they have already paid to develop for retail consumers.
The Chevy Colorado.
Right. They modify it for military specifications, and they sell it under federal contracts that offer highly predictable revenue streams and double-digit profit margins. They are forecasting a compound annual growth rate for GM Defense of over 30% for the next several years. And they are even applying their Ultium battery technology to aerospace.
Aerospace?
Yeah, they secured a piece of a $220 million NASA contract with Lunar Outpost to develop the next-generation lunar terrain vehicle.
Wait, so we've got Chevys heading to the lunar surface.
Basically, yeah.
That's amazing. But closer to Earth, GM Insurance is quietly becoming a major operational pillar too, right? They've scaled this division from operating in just 3 states at the beginning of 2024 to 21 states today.
And GM Insurance is a strategic flywheel.
How does that work?
Well, by embedding insurance offerings into the point of sale, they capture recurring premium revenue right off the bat. But more importantly, When a covered vehicle is in an accident, GM Insurance naturally directs the repair process towards certified GM collision centers.
Ah, keeping it in the family.
Exactly. And those centers use original equipment manufacturer, or OEM, parts. This drives incremental, high-margin parts revenue back to the mothership while ensuring the vehicle is repaired to factory standards.
Which keeps the customer happy and protects the brand.
Right. It protects the long-term brand equity and the vehicle's residual value. They currently have coverage available for over 60% of their U.S. sales footprint, with plans to exceed 80% really rapidly.
Okay, let's synthesize all of this data because it leads directly into the third crucial component of our analysis. Management guidance.
The forward-looking stuff.
Exactly. We have a company generating massive ICE cash, shrinking its float, enduring brutal macro tariffs, bleeding cash to fix its EV mistakes, but simultaneously growing a hyper-profitable software and defense arm.
It's a lot of moving parts.
It is. So when you put all those variables into the blender, what did management actually promise Wall Street for the back half of the year?
They promise significant growth. In a macro environment where many industrial peers are tempering expectations, lowering guidance, GM confidently executed a raise and reiterate across all their key financial metrics for the 2026 full year.
And the numbers on this upward revision are substantial. They raised their core operating profit, EBIT adjusted, to a range of $14 billion to $16 billion.
Right, which is a bump up from the previous $13.5 to $15.5 billion.
They raised EPS guidance to $12 to $14 a share. And most critically for the buyback thesis, they raised adjusted automotive free cash flow to a massive $9.5 billion to $11.5 billion window.
Raising free cash flow guidance by $500 million while actively fighting a multi-billion-dollar tariff war is a profound demonstration of operational leverage.
It really is. It takes a lot of confidence.
It signals extreme confidence in their pricing power and their cost-cutting initiatives. But what is particularly notable is that management didn't just restrict their optimism to 2026.
Right.
They provided a very aggressive, very bullish outlook for 2027 as well.
Yeah, the 2027 product cycle seems to be the linchpin of this whole thesis, because in December 2026, they initiate the launch of the next generation Chevrolet Silverado and GMC Sierra light-duty pickups.
The bread and butter.
The real money makers. And this isn't just a minor facelift, this is a total architectural overhaul launching simultaneously across 3 assembly plants, coordinated with the rollout of next-generation V8 powertrains at 3 propulsion plants.
It is an incredibly complex industrial ballet. The risk during a major product changeover like that is that assembly lines have to stop, right? Which results in lost production volume and lost revenue.
Yeah, factory downtime is brutal.
But management was adamant on the call that they plan to maintain their current record-breaking production volumes throughout this entire launch sequence. They are prioritizing a seamless transition to ensure dealer lots are never starved of inventory.
Dan Levy from Barclays actually pressed them on the economics of this new truck launch. Because, when you introduce a completely redesigned vehicle, you generally have to offer heavy incentives on the outgoing older model just to clear it off the lot.
Right, the fire sales.
But management pushed back on that assumption completely.
They did. They noted that because demand is so structurally robust right now, the current generation trucks are exiting their life cycle without requiring those margin-destroying fire sales.
They're just selling out at regular price.
Exactly. This sets up a highly favorable dynamic for 2027. The new trucks will arrive, featuring significant upgrades in ride quality, towing capacity, and of course that standard Super Cruise hardware we discussed earlier.
Right.
And management heavily implied they see an opportunity to take incremental price on these new models, expanding their margins even further. Coupled with an expansion in manufacturing capacity for their highly profitable full-size SUVs slated for next spring, the 2027 cash flow setup just looks formidable.
Okay, I am going to throw a flag on the play here because this narrative is getting dangerously close to, corporate utopianism.
Fair enough. Let's ground it.
I read the transcript and I saw the guidance raise, but I also saw management spend a significant amount of time highlighting severe systemic headwinds. They aren't operating in a vacuum here.
No, they certainly aren't.
They explicitly modeled $1.5 billion to $2 billion in full-year headwinds from commodity inflation, logistics friction, and a very specific spike in DRAM memory chip costs.
And the DRAM cost issue is a perfect illustration of the modern automotive paradox.
Because cars are just computers now.
Exactly. As vehicles transition into rolling data centers, powering high-definition infotainment screens, complex sensor suites for supercruise, and constant over-the-air software updates, they require massive amounts of computing memory.
Right.
The global spot market for DRAM has tightened significantly, and GM is fully exposed to that price volatility.
Okay, but beyond just the supply chain, there is a massive macroeconomic disconnect happening right now.
What do you mean?
Every major bank, every financial analyst is publishing reports stating the American consumer is tapped out. Credit card delinquencies are rising, interest rates have made auto financing completely punitive, and household savings have eroded.
That is the consensus, yes.
So how can management project record sales and pricing power for an $80,000 luxury pickup truck when the consumer base is supposedly suffocating? Is management just whistling past the graveyard here?
That exact tension was the focus of a direct question from Morgan Stanley analyst Adam Jonas. He challenged the executive team on whether they were modeling a mix shift downward.
Like people trading down to cheaper cars.
Right. Meaning, are they preparing for consumers to abandon the $80,000 Denali and trade down to a $30,000 Trax due to economic exhaustion?
And what did they say?
The response from leadership was essentially a flat denial of the macroeconomic consensus. They stated plainly that they've been waiting for this supposed consumer slowdown for over a year, and it simply has not materialized in their order banks.
They just aren't seeing it.
They are not. They are experiencing unrelenting demand for the most expensive, highly optioned vehicles they produce.
So it's basically a tale of two economies.
Exactly. It highlights a bifurcation in the consumer economy. The demographic purchasing an $85,000 fully loaded SUV is largely insulated from the day-to-day friction of core inflation.
They aren't worried about the price of eggs.
Right. Their purchasing power is intact, and their appetite for premium automotive products remains unsated. While management acknowledged that, a prolonged, severe recession would eventually alter buying patterns, their current real-time telemetry shows a consumer base that is willing and able to absorb price increases.
Which brings us to the ultimate question for you, the retail investor. We have analyzed the margin recovery, the dominance of the ICE portfolio, the mechanics of those massive share buybacks, the painful realities of the EV restructuring, the tariff evasion strategy, and the explosive growth of the software and defense divisions.
We've covered a lot of ground.
We have weighed the massive free cash flow against the stubborn macro headwinds. So, based on the totality of the Q2 2026 data, what is the verdict? Bearish or bullish?
Unapologetically bullish. The data paints a picture of a management team executing an absolute masterclass in pragmatic capital allocation.
The thesis basically relies on their ability to use the past to fund the future, right?
Yeah, that's exactly it.
They aren't abandoning their legacy business to chase a theoretical EV market. Instead, they are optimizing the legacy business to extract every possible dollar.
Precisely. They recognize that their dominant position in the North American combustion engine market is an unassailable cash moat, and they are ruthlessly monetizing that moat to absorb the $10.9 billion cost of untangling their EV supply chain errors and the billion-dollar cost of physically relocating factory to escape tariffs.
They are self-funding their own transformation.
Exactly, without taking on destructive levels of debt.
But the most actionable, undeniable mathematical reality for the retail investor is the share count. The aggressive, sustained reduction of the float changes the entire risk-reward profile of the equity.
It's the biggest driver of value here.
By shrinking the outstanding share count by 35% in 3 years, the intrinsic value of every remaining share has compounded massively. You hold a larger claim on a business that is generating over $10 billion in free cash flow, while they quietly construct a high-margin software and services empire inside the shell of a legacy manufacturer.
It is a phenomenal mechanism for long-term wealth creation for the patient shareholder. They are buying out the skeptics and concentrating the yield for the believers.
And that leads directly to a final provocative question for you to consider as we close out this deep dive. Think about this. Management has proven they can generate $3 billion in annual software revenue with 70% profit margins.
Unheard of in auto.
They have $6.3 billion in deferred revenue waiting to be recognized. They are converting 40% of hardware trials into persistent monthly subscriptions.
It completely disrupts the traditional automotive valuation model. Historically, Wall Street assigns a very low multiple to auto earnings because the business is viewed as highly cyclical and capital intensive.
Exactly. So here's the question you really need to ask yourself as you model this stock. If General Motors continues the successful pivot, If they transition from a company that sells you a heavy piece of metal once a decade into a company that charges you a high-margin monthly subscription to let that metal drive you hands-free while insuring it through their own captive agency.
That's the real pivot.
Right. Are we still looking at a traditional low-margin automaker, or are we looking at a massively undervalued recurring revenue tech company wrapped in sheet metal just hiding in plain sight? Dig into the numbers, stress test the cash flows, and see where the data leads you. Thank you for joining this deep dive. Keep asking questions, keep doing your own research, and we will see you next time.